What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about Cathie Wood and Ark Invest. And there was a research report published by Morningstar taking a huge stab at Cathie Wood and of course Ark Invest and talking about the biggest value destroyers over the last 10 years. And this article really puts things in perspective and kind of goes over the last 10 years worth of history in which funds or family of funds have essentially lost most value for shareholders during that time period, in a time period when the markets have, of course, been on a very strong bull market, hitting new all-time highs. So I hope you all enjoyed this video and a little bit of an update on Ark Invest. We're going to be taking a look at their performance, some of their portfolio holdings and how they've performed as well. Make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below if you're interested in joining us. And there is a 16% annual discount available until the end of this month. And you can access all the trade alerts, including buy and sell alerts, options alerts, trade ideas, as well as over 50 plus videos and tutorials that are members only content, and as well as our early access to the beta launch that we'll have for the moneyvest.com platform as well. So this right here was the research report. Ark tops the list for value destruction even during a generally bullish market. These fund families managed to lose value for shareholders. So mutual funds and exchange traded funds, so mutual funds and ETFs, it's an insane how big this market is, and they created a total of $11.1 trillion in shareholder value over the last 10 years through 2023, thanks to the generally bullish market during most of this period. So $11.1 trillion in value gains in the last 10 years. And the top wealth creators were all well-known funds in plain vanilla fund categories such as large cap blend, large cap tech, more specifically allocating 50 to 70% equities, and foreign large blend as well. And the winners list, led by Vanguard total stock market funds here, was dominated by the biggest fund families including Vanguard, Fidelity, and American funds as well. And this reflects a positive feedback loop of size and performance as well. And this right here are going to be some of the 10 categories, not ETFs or fund families, but categories which saw the biggest value destruction over the last 10 years. And it's actually quite an interesting list. First one is trading inverse equity. So anybody who was obviously short equities or trading inverse ETFs that were betting against equities, or they were betting on this idea that equities are going to go down. That's why the inverse ETFs or mutual funds are going to go higher. Obviously lost a ton of money, and that is an estimated wealth destruction of $41.8 billion in the last 10 years, absolutely wiped out. The second category, which comes as no surprise actually, is going to be China. So the Chinese region saw an estimated $14.8 billion in wealth destruction as Alibaba, Tencent, Baidu, NIO, a lot of the Chinese EV manufacturer companies also went through a ton of regulatory issues, fines, and oversight from the government, CCP, and there was a lot of issues around Chinese stocks. And as a result, they obviously got sold off pretty aggressively as well. Trading inverse debt is also accounting for $3.8 billion. Systematic trends, about $0.6 billion. Commodities, broad basket, trading leveraged commodities. Also, again, a lot of them have to do with leveraged ETFs, right? Inverse ETFs, leveraged ETFs. And again, that creates a lot of volatility. And also, even though it can be very attractive, or the potential, just the word that I'm using, the potential gains can be very attractive, it's always important to remember that trading levered ETFs is always risky. It carries significant amount of risk, and they're never meant to be held long term, because long term, as we already know, the bull market is extremely strong and can absolutely wipe out anybody who's short in the market or trading on an inverse basis. Now, let's talk about the top 10 wealth destroying fund families over the past 10 years. We've got Ark ETF, ahead, like literally beyond any other ETF, more than twice its closest competitor here in terms of estimated wealth destruction of $14.3 billion. Crane shares are second at $6.5 billion. Then we got Credit Suisse, of course. Credit Suisse had a huge sort of regulatory issues over the years, legal issues over the years, and then finally got shut down, got bought out by UBS. $5.3 billion in estimated wealth destruction. That still seems a pretty small number for the size and scale of the bank here. The Global X funds, Pro shares, again, a lot of that probably is coming from inverse ETFs. We got Barclays, we got Advisor shares, we got Cromwell, and we got Roundhill Investments as well, all accounting for anywhere between about half to as much as $3-4 billion respectively, but nothing comes close to Cathie Wood and Ark Invest as well. So Ark, home of the flagship innovation ETF ARKK, tops the list for value destruction after garnering huge asset flows in 2020 and 2021, totaling an estimated of almost $30 billion. And that's, of course, where the hype was. We saw a significant amount of inflows during that time, and its funds were decimated in 2022 bear market, of course, with losses ranging from 34 to as much as 68% for the year. And many of its funds enjoyed a strong rebound in 2023, but weren't enough to offset the previous losses. And of course, the Ark family wiped out an estimated $14.3 billion in shareholder value in the 10-year period. And of course, in 2024 also, despite the markets pushing higher, the NASDAQ up a very nice 9-10%, S&P also pushing higher, Ark Invest continues to struggle and slump in 2024 as well. And this right here are going to be some of their holdings in their innovation ETF, which is a proxy for speculative technology stocks in the US. Extremely volatile environment, and its 1 year performance relative to the S&P 500 looks like a roller coaster back to its inception in 2014 as well. And as you'll notice, some of the biggest positions, like 10.9% weight in Tesla, year to date down almost 30%, as we already know. Tesla is also one of my big positions, and again, I'm optimistic on it long term. But then again, we've got very questionable companies, right? Like Roku. I mean, there's a whole research paper and a whole thesis around streaming and Roku as a company and how it has huge potential. Down 33%, of course, not profitable right now, so we don't have a next 12-month, forward 12-month price earnings multiple. 8.7%, so pretty heavy weight. Coinbase here, 8.4% weightage, up 14.5%. It's probably the only bright spot because Bitcoin and Ether is at an all-time high. Then we got Block down 7%. We got UiPath, again, not a super profitable company, down about 18%. Roblox, not a profitable company, down 28%. CRISPR Therapeutics down 11%. Robinhood, which is a smaller allocation, 4.2%, is probably up the most of 40%. And then Palantir, of course, we know how Cathie Wood's been back and forth here with Palantir. She's bought, she's sold, she's bought, she's sold again. 3.1% allocation, which is, again, up a lot, 26%. And then Zoom, again, what's the long-term business model for Zoom, right? If anybody can help me understand what's the proposition there, I would love to know. But we've analyzed Zoom in the past. It's got a great balance sheet. It's got great margins. It's got great liquidity. But the revenue generation long-term, the moat, more specifically the moat, can other companies replicate what Zoom already does? And the answer is yes. I mean, Google Hangouts, Apple FaceTime, there's a lot of companies like Microsoft Teams, there's a lot of companies that are already doing what Zoom did. It says that Zoom obviously gained a lot of attention during the pandemic, and again, down 11% year to date, trading at, of course, really, really low multiples, 13 times on a forward P multiples. You can argue that it's really, really cheap. But the idea is, of course, down about 14% year to date compared to the S&P 500, which is up 11%. So that is a significant underperformance on a year to date basis. This right here was from, let's see, so Rave Found basically mentioned that we don't see Ark's names catching a bid until the Fed starts cutting interest rates and yields move sustainably lower to help support their hefty valuations. As we have said many times over the last few years, we prefer the NASDAQ composite. NASDAQ 100 tracked by the QQQs is better ways to play the theme of disruptive innovation, is what they also mentioned as well. Now, the interesting thing is that, Cathie Wood and Ark Invest very much were dependent on the macro thesis, right? They were always constantly focused on interest rates coming down. There's been multiple Twitter posts from Ark Invest and Cathie Wood talking about how interest rates are really high. It's going to be a shock to the economy. Interest rates need to come down because eventually this is really going to put a lot of pressure on the system. But at the end of the day, the economy continues to be very strong. It surprised me, it surprised her, it surprised Jerome Powell, it surprised pretty much everybody how resilient the economy is. And inflation, of course, is cooling off, but not at the same pace as what we expected. And Jerome Powell also mentioned that they're lacking that greater confidence that they need to bring interest rates down because inflation is still above the Fed's target. So the entire thesis was, of course, built on this idea on macro play, right? Because they wanted interest rates lower, so that interest rates lower creates a quantitative easing environment, which creates more potential momentum and upside for individual stocks, more specifically technology and some of the more higher valuation stocks, more higher growth stocks that may not be profitable. And again, that's where the entire thesis was built. And as a result, again, this right here was a significant underperformance, down about 79-80% against the S&P 500 and consolidating sideways as ARKK still struggles to recover from its all-time highs. Of course, 158 still down about 72%, year to date down about 12.6 compared to the S&P 500, which again is hitting a new all-time high as I'm talking right now, up 12% year to date. So let me know your thoughts down in the comment section below, and what do you take away from this, and what kind of lessons can be learned? Because look, it's really important for us to learn lessons from other people's sort of mistakes and whatever they do, even successes. I think it's really important to learn from other people's journey. And I know that 2020, 2021, Cathie Wood was probably at the top of the list for names where liquidity is flowing into, where Ark Invest is, gaining a lot of assets under management. And then things, of course, completely changed in 2022. And of course, they still haven't recovered yet, where the market, the overall S&P and the NASDAQ continues to be very resilient, as it always has proven to be, hitting new all-time highs. So let me know your thoughts down in the comment section below. As always, make sure that you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members-only private videos, including all the trade alerts and ideas. 16% annual discount available until the end of this month. As always, happy investing. I'll see you all in the next video.